Okay, so welcome. We're going to spend an hour or so together talking about lines of credit, and I'm really excited to have this topic. This is the first time we've offered this topic at Women's Enterprise Center. Before we get started on that, I just want to give you a little bit of background on Women's Enterprise Center. I know you've all been on our website to register, so you've probably seen lots about the organization, but just so that you understand what we are not-for-profit. We are funded through the federal government, that's Western Economic Diversification, and we've been in the province for over 20 years now. We do have a provincial mandate, so we have a number of offices. I'm here in the Kelowna office, and we have an office in Vancouver, and we have an office in Victoria as well. I'm one of the business advisors who provides support to women in business, and that is one of our big mandates, providing support to women in business, along with our financing program. We do have a lending program. It's a maximum of $150,000, and we offer information on that every 2 weeks as well if you're interested in phoning in to learn about our finance program. We're not going to cover our finance program here today, though. We're going to talk about lines of credit. And I'm so excited to have with me today two guests. Sitting with me actually in the office is Mike Porter from Prospera. Mike works out of the Kelowna office, so he's joining us here in person. But I also have with us Caillie Hayes. Caillie is with us from RBC, Royal Bank of Canada, and she's in their Maple Ridge office. So really excited to have them both here today. And just before I ask them to introduce themselves, I just want to give you a little bit of background on why we're offering this session. As a business advisor with Women's Enterprise Center, one of the things I do is I spend a lot of time reviewing loan applications. So I've seen financing requests from all kinds of businesses across the whole province. And applying for a loan is one thing, but I often have women ask me, if we provide lines of credit, which unfortunately we're not able to. So how do they get a line of credit, and should they get a line of credit, and what is really a line of credit, and how do they repay that line of credit if they get a line of credit? Because if you're looking for a line of credit, we would be referring you back to your financial institution, because it's the financial institutions that provide those lines of credit. And that's why we're here today, because we do get a lot of questions about lines of credit, and lines of credit can be so helpful for women in business or anyone in business. And we wanted to bring in the experts, so we brought in Mike and we brought in Caillie. And I'm going to ask them to introduce themselves now, just give us some background on what kind of work they do and how they're involved with lines of credit at their respective financial institutions. And because this was Mike's idea, I'm going to start with Mike, and I'm going to ask Mike to introduce himself first.
Thanks, Cheryl. Good morning, everybody. My name is Mike Porter, and I'm Business Relationship Manager for Prospera Credit Union. My role here is to help local businesses be successful, and with Prospera, we have branches all the way through the Okanagan down to the Lower Mainland, head office down in Abbotsford. So on a daily basis, I'm meeting with entrepreneurs in all industries. Generally, I try to meet with them out of the office on site to try to really help support them with their needs and their goals, including their staff and their families as well, just to offer a holistic approach to help them be successful. Prior to joining Prospera Credit Union, I worked for the Business Development Bank for about 5-6 years. And then I worked with Futurepreneur Canada, which also helps young entrepreneurs in Canada start up their businesses. And I had a region from for most of the interior all the way up to Whitehorse, Yukon. So that's kind of me in a nutshell. Prospera Credit Union is a credit union, so we're member owned. Each member of the credit union has a share, and we return our profits to our community members. And we also donate about 5% of our pre-tax profits to our communities and local charities. So we're kind of a feel-good financial institution.
Nice, great. Thank you, Mike. Caillie, you're joining us from Maple Ridge. Welcome.
Hi, and thank you so much for having me. So as you all know, I work for Royal Bank of Canada. We're kind of all over the place. I am a commercial account manager, and technically what that means is that I do deal with businesses that have credit needs of over $750,000. But that doesn't mean that I haven't had experience within the small business segment. I have worked at several different financial institutions over the past 10 years, all in the business side of, basically the business side of the organization. With RBC, we are involved with the community as well. We do tend to focus our efforts on basically the same approach. I mean, we're all doing the exact same thing. We're looking at what our businesses need, what they require. We do have several different types of specialization. And so my curiosity to the people that are on the line today are, are you more of a startup or are you more of an established business? Because that's really going to kind of dictate the way that our conversation kind of goes and what kind of advice I can provide today.
Excellent. Thank you, Caillie. And that's nice that you put that out, the difference between a startup and existing business. So let's tell people how they ask those questions when they do have questions, because we'll be covering a number of topics, and we do want to encourage you to ask your questions as well. And you can type those questions into the chat box or into the Q&A. We have Caillie joining us here in the office who's going to be monitoring those questions. And as the questions come up, we'll try to make sure we can get to as many of them as possible. So good reminder. Thank you, Caillie. All right, so let's get started. The first thing I think we need to cover is what is a line of credit? People hear that term. It's something that people ask me all the time is, should I get a line of credit, or how does that work if I get a line of credit? So first, I think we should be really clear on what a line of credit is and how it's different than a loan. So maybe I could throw that one over to you, Caillie, and start with you on this one. What is a line of credit? How would you describe a line of credit to your clients, and how would it be different than a loan?
So a line of credit is specifically designed to basically fix the working capital gap. So what we mean by that is when you get paid and when you basically send out your invoice and when you get paid, there's a bit of a gap there. So we refer to that as the working capital gap. That can be either for accounts receivable or for inventory, and it's essentially meant to cover and fix that working capital gap. It's not meant to stay as a fixed line for an extremely long period of time. Within the year, it is meant to revolve, meaning it will go back down to zero at some particular point. But it's essentially built to maintain and bridge that gap.
So if I could just paraphrase that, then see if I have this right. What you're saying is a line of credit is money that is when you need to pay for something and you don't have the money, so you use the line of credit. Is that what you're saying? If I'm a
That's correct.
Right.
Yeah.
Great.
That's correct. Where a loan is meant for an actual capital asset, so something that you're purchasing that has a life. There's a life expectancy of the actual asset itself. So technically, the asset's only going to last for say 5 years, or 7 years, or 10 years, or 25 if it's basically a building or something along those lines.
Right.
But a line of credit is specifically just to bridge the gap on when you get paid and when you actually issue an invoice.
Right. Okay. And I know you mentioned there that a loan may be for purchase of an asset, and just just for you out there, there are different kinds of loans, and loans can cover different things other than assets. So I just don't want people to think that the only thing for a business loan is to cover the purchase of an asset, but certainly that's one thing the loan would do. And different lenders provide loans for different things. So let's move on there, though. Mike, do you have anything you wanted to add to that definition of what you think of a line of credit and how you frame it to your clients?
Yeah, I think Caillie really kind of framed it pretty good there. A good example of where a line of credit would come in handy for a lot of businesses that we see in the Okanagan. We have a lot of seasonal and construction-based, trades-based businesses, and sometimes the gap between when they can invoice and when they get paid, like as Caillie was mentioning there, and considering all the supplies that go into maybe a construction job site, so that's a lot of cash going out, and then there's a gap between when they get paid from their customer. We need to help make sure they have enough working capital to keep paying their employees, for an example, or paying their bills or their fuel, things like that. So a line of credit really is essential, especially in industries where there's a big gap between money out and money back in.
Right. Okay. Good. And so, Mike, then what would be the advantages or disadvantages to getting a line of credit versus actually getting a loan?
Mm-hmm. With a line of credit, we establish a limit which we review annually or more frequently if required. We keep that limit in place. So Caillie mentioned revolving. That means you use it and then you pay it back down to zero, and then you use it and then you pay it back down to zero. It's a healthy way to use that line of credit. It's a benefit. It's always there for you when you need it, or if something unexpected comes up, it's there. You don't have to come in and fill out a loan application and go through that. It's nice, and it's a simple, easy to use credit facility.
Okay. And Caillie, did you want to add on to that?
No, I think that that pretty much sums it up.
Okay, let me just speak to that a little bit too, because we're kind of moving to some of the other topics, but it's good to clarify these things up front. So what Mike and Caillie were saying there is that, a line of credit is a certain amount of money that a financial institution approves you for. And you guys correct me if I'm wrong here, because we don't do lines of credit at Women's Enterprise Center. So, if I don't have it right, please jump in. So a line of credit is a certain amount of money that the financial institution approves you for, and it sits there available to the client. And then when you, the business owner, need that money and you don't have enough money coming in from your revenue or through your cash flow, you can go and access that line of credit at your financial institution up to the limit of what you've been approved. Did I get that right?
Yeah, that does sound right.
Caillie?
That's correct. Yeah.
Sound right to you?
Yeah, that's correct. Yeah.
Okay.
In some financial institutions, a line of credit is a separate account from a checking account. So you sometimes have to move funds from one account to the other account. With us, it's all one and the same. You can just go into the negative up to the limit of your line of credit.
All right. How does that work for you at RBC, Caillie?
So we have a combination of a few different options. It really just depends on the client and what the client's needs are. So we have a line of credit that's attached to the account essentially, but we also have a line of credit that's separate from the account. And basically what it will do is it'll pull if necessary, but you don't have to stay in it at all times. It's meant to kind of keep people out of staying within the line of credit to ease off the interest associated with it.
Interesting. Okay, thank you. And I'm glad you brought that up because we were going to get to that. Maybe we can talk about that now just because it has come up, and that's the interest that you pay on a line of credit. Caillie, do you want to jump into that one, seeing as how it's brought it up?
Yeah, no, absolutely. So I guess the biggest thing, and kind of how I would preface the conversation, is when it comes to actually fixing a rate, it's all going to depend. So banks have, all financial institutions have risk-based pricing. Generally speaking, it's not always fixed. So it depends on the type of product that you're looking at. And the reason why I specify it out as a product is because every financial institution has different products, which is one of the reasons why I was asking whether or not, the majority of individuals were startups or not, because certain financial institutions have startup programs where they basically auto-approve you for a line of credit, but that line of credit is obviously going to be priced higher because it's an auto-approval. So it's a completely different based system. If you are being risk assessed, essentially we're looking at, what is the security that we have to be able to provide you with this line of credit, then we're going to be looking at rates from a different perspective. So I guess I should start off with normally how banks indicate how somebody would basically qualify for a line of credit. It would be based on a percentage of your accounts receivable, or a percentage of your inventory, or a percentage of your sales, depending on which is the lesser of. And that's usually how we indicate what kind of line of credit limit you should receive. Now, depending on whether or not we margin that, or we keep it as an unsecured basis, your rate is going to fluctuate. So it's not really a concrete answer, unfortunately.
Yes, but no, I'm glad you brought that up though, because that is important. Because when we talk about lines of credit, we think of that as quite simple. It's just really simple. You just get approved for a line of credit and it's some money that's available to you. But it's good for people to hear that it's not that simple and it's actually complicated. And that's one of the reasons that we're doing this. If I could just go back for a minute to the interest piece, because I do get asked this a lot, and I just want to make sure we're clear on it. The bank or the credit union would assign a percentage, an interest rate that the lender, the borrower would have to pay. So, in the same way that if you've got a car loan, you pay interest on that car loan, whether it's 1%, 2%, 4%, 8%, whatever it is, wherever you borrow the money from, there's interest. And the same is true on a line of credit, that you have to pay interest on the line of credit. the question that I get asked from clients, and I don't know if Caillie's got any questions up there yet, but I know one that I hear is people want to know, well, what's the interest? What do I have to pay? What's the interest rate on a line of credit? I know it's black and white. So we don't need a black and white answer, but and do I only pay interest when I borrow the money, or do I pay interest on the whole amount of money that's available to me? So why don't we continue down that interest? I see Caillie's nodding that we do have a question on interest. So maybe throw this one over to Mike this time.
Sure. So the interest rates are determined, I think Caillie kind of touched on a bit there, if there's security or not. At Prospera, we try to keep things as simple as possible and obviously offer solutions that are flexible. So if a member wants an unsecured line of credit, we'll look at things like their credit bureau score, we'll look at their net worth, the type of business, evaluate the risk, and then we'll put it into a matrix, and that kind of determines what a rate variance is. And that's just a kind of a fancy way to say prime plus a certain number is your interest rate. So if it's an unsecured line of credit, it can be prime plus 2 or 3%. So with prime being just a little over 3 plus percentage variance, that will give you your rate.
Right. And just for those of you that are unfamiliar with prime is the amount set by the federal government of Canada.
3.75.
3.95 right now. It just jumped up.
It just jumped up.
It's always jumping up.
It's always moving around, right?
Yeah, they're always moving around.
Anyways, so the interest rate would be prime plus the variance. And you won't pay in, if you don't use your line of credit, you're not paying any interest, obviously, because you haven't used any of that facility or those monies.
Okay, so let's be clear on that. So the only time you pay interest on a line of credit is on the portion that you use.
Right.
All right.
Some financial institutions will charge what's called a facility fee. It's a monthly fee to have access to those funds if you use them or do not. For local business with Prospera, we don't charge monthly facility fees.
Oh, interesting. I didn't know that about line of credit, that there could be a fee attached to it just to have it available to you. Can we talk about that security that you brought up, Caillie, and Mike's brought it up as well. So I think we should address that, whether a line of credit is secured or not. You know, let's talk about that and make sure our listeners are clear on that security piece. So I'm going to just throw this out here, and Mike and Caillie, you know, you if I don't have this right for your institutions, by all means jump right in there, because every institution does things differently. So security are generally assets. They're things that you would own. Sometimes they're personal things you own. Sometimes they're business things that you own. And some institutions will look at business assets or personal assets. And you offer that to the lender. You say that if you're unable to pay that line of credit, the lender can go and access those things, those assets, and sell them to get some of their loan money back. Right? So that's what they talk about when they talk about security, is you pledging an asset, a thing, something to the lender, so that if something bad happens for whatever reason, and sometimes bad things do happen, so if something bad happens and you can't pay that line of credit back, the lender can sell that asset to get some of their money back. Caillie, is that what you're meaning when you talk about secured lines of credit?
Yes and no. So what I'm essentially meaning by that is it really just depends. So say you're doing a line of credit for under $250,000, and this is pretty much standard across the board with most financial institutions. What we technically look at under that amount is personal net worth, and we take a look at what the person's credit situation is. Because sometimes in those particular instances, it's more of a sole proprietor or smaller business. So when we're looking at that smaller line of credit, or from that scale perspective, we're taking a look at the person. And so the security in that case would be, what's their credit bureau like? What's their net worth like? And then the security is based on the individual person. When you get to actually securing what we would refer to as an asset, whether that's accounts receivable or inventory, or we're putting a general security agreement on a business, that's a different type of security that we put into place. So it's risk is priced differently at that point.
Okay, great, thank you.
So it depends on the quality, I guess, of the asset that we're looking at.
Right.
And then
and the amount they're applying for. So you at RBC, you're using that $250,000 as the threshold, and under $250,000, it's more about the personal net worth of the client, and then their credit score and credit situation versus actually pledging a tangible asset.
Correct.
Okay, got it. Good. Okay, how about at Prospera, Mike?
Yeah, again, kind of nailed it there. So when we think about things like assets, so accounts receivable is an asset as long as it's a healthy receivable. So,
can you just tell us what that is? What's a healthy receivable?
Yeah, so if you're expecting to get paid by a customer and invoice has only been outstanding for about 30 days and they pay regularly, then it's a pretty reliable source of funds. If you have a customer that hasn't paid, they're 30 days past due, maybe they're hitting 60 or 90 days, well, then all of a sudden that asset is not as reliable, it's not as valuable as a security for a lender. So we look at things like that. With local business, though, we tend to not really dive into that too much. We just want to try to keep things as easy and simple as possible. With inventory, so if you think about like a restaurant and taking that security, taking food for a security, it's got a very quick turnover spoilage rate, so it's not very great, not a great option actually for an asset for a line of credit. But perhaps maybe other equipment in the restaurant might be, right? Things like that.
So would you also then be looking at personal net worth and the credit situation?
Yeah, and we're lucky we're pretty flexible there. We do look at personal credit scores. We try to take a holistic approach, and we do understand that entrepreneurs in general take quite a bit of risk here and there, and that their credit scores do go up and down. We look at net worth. So if they have a fallback position outside of the business, or if their character is that they're going to pay personally, then they're probably going to pay commercially. Okay, if that makes sense.
Yeah, that's good to know. We've got a good question up, and let's tackle one of the questions here. The question is, and this talks early to what Caillie was talking about, when she threw out that GSA term. I don't know if y'all caught that, so let's circle back to that. Does the CEO usually have to give a personal guarantee on a line of credit? And we can expand that a little bit. It could be the CEO, it could be the directors of the corporation, or it could be the corporation. But I guess that if we broaden the question a little bit, what kind of personal guarantee is required on a line of credit? Caillie, over to you.
So generally speaking, again, it depends on the amount. So if you're talking about an established business that has been in business for a very long period of time, negotiating a GSA is something that you can do in the higher in the higher limits. I would say under that $250,000 threshold, you're going to be personally guaranteeing. And so generally speaking, it's anybody who's considered a beneficial owner would be a personal guarantor, because they're going to receive some kind of benefit from the actual company itself. So if the CEO is the beneficial owner, then they would be signing a personal guarantee. Not signing a personal guarantee is something that usually, I would say, that wouldn't be very common, because it's typically our only form of security at that point in time, especially if you're talking about a startup business or something along those lines. A GSA, I just saw that pop up, which is a general security agreement. That is something that pretty much every single bank will put on a business when they do any kind of lending for them over a certain amount. So it just typically depends on the amount threshold for each financial institution, and every financial institution is different. And basically what that stands for is it's a first priority ranking, meaning that if the business was to fail, the banks or the financial institutions have a leg to stand on if it goes to court, and they have first right to basically the liquidation of assets.
So Caillie, can you explain then for our listeners, what's the difference from the GSA and the personal guarantee?
So a GSA is like a personal guarantee for the company. So because a corporation is essentially its own, so it's going to depend, right? If you're a sole proprietor or partnership, you're going to be personally guaranteeing anything because there is no corporation to actually sign a GSA. In the case where you have a corporation, it's its own identity. So because it's own identity, a GSA, or a general security agreement, is something that you would sign on behalf of the company as a signing authority to indicate that the company is essentially personally guaranteed in sort of a way to phrase it so that it kind of makes a little bit more sense.
Right. Okay. So let me just recap that, and then we'll go over to Mike. So the GSA is what the corporation is going to sign, saying that they agree to pay the money back. And the personal guarantee is going to be what the owners or directors, shareholders sign sometimes, or if they're maybe just a proprietorship, they sign personally saying that they will agree to pay the money back. Did I get that right, Caillie?
Correct.
Okay, good. Mike, how does Prospera see that?
Yeah, very similar. I think as a business owner, entrepreneurs should expect to be asked to sign a personal guarantee if they're as a security for a line of credit. It shows that you stand behind your business, right? Sometimes companies are incorporated to create some protection, some separation between owners, for example, and the company. And I think they used to call it like piercing the corporate veil, for example, getting a hold of the owners to have some skin in the game. And it really shows that a personal guarantee shows that the owner is committed to the success of the business.
It's a good point, actually, because I get asked this a lot, and my clients that I work with are often quite shocked that they're asked to sign personal guarantees, especially if they've incorporated, because the general feeling out there is that I'm going to incorporate specifically so I don't have to sign a personal guarantee. But my understanding from all the banks and credit unions that I work with is the personal guarantee is pretty much required across the board now. Mike's nodding his head. Caillie, would you agree?
Yes, I would agree.
Yeah. Okay. Good. Thank you. One thing I wanted to go back to, you talked about part of the assessment in determining whether someone is eligible for a line of credit is you look at their personal net worth and you look at their credit situation. So those two things have come up. Let's tackle each of those separately if we could. When you talk about, let's work backwards, talking with the credit situation first. So when you look at someone's credit, what are you looking for? Is there a minimum threshold? And how do you assess credit to determine if the credit is strong enough for your institution? Mike, do you want to kick this one off?
Yeah, we look at it from a couple of different perspectives. I think across the board, financial institutions are looking at a score called a beacon score. Entrepreneurs can find out what their beacon score is if they want to go onto wec.ca, and they can pay a little fee or send a letter in and get a copy of their credit report. I always encourage entrepreneurs to know what their credit is or what their credit report looks like before they apply for a loan, just to understand it, because it's such an important piece of your personal credit needs as well as your business needs. We look at what's also called a bank nav index, a BNI score. And that score outlines the propensity to go bankrupt within a couple of years. And that could be a case where you've got someone that has all of their credit facilities, their personal credit cards maxed out, a lot of late payments, no access to any other credit facilities, things like that. So we'll use those as a guide, but really we have to dive into the various credit facilities that they have underneath that. How long have they had their credit cards or car loans or mortgages, things like that? How often are they seeking credit? If you're seeking credit multiple times, it's going to hit your credit score and lower that. Are you a credit seeker? That's a risk. Things like that. Yeah.
So you're looking for risk factors then. You're looking for how much debt they're carrying, how regularly the debt is being paid, is it being paid on time, if they're shopping around looking for money, how often they do that, and generally how they're managing their debt load. You're looking at that as well as that actual score that Equifax would produce. Right? Caillie, how about for you?
Like I said, it depends on the different institution that you're kind of working with, and it depends on the level. So for myself, the credit score can be mitigated in my department, but I'm dealing with larger limits, so it's a little bit different. If there's any hits from the R status, which is basically R1, meaning you pay your bills all the time, R9, meaning you've completely defaulted, that is an indication to us that there's a credit risk on the personal side, but we don't always take into consideration the score as much when you're talking about the higher limits. If we revert back to small business, I would say that, and I think it would be fair to point that out, especially on the credit union side, and Mike should be able to answer that, is that generally most of the credit unions have a minimum score threshold for you to even become a member. So if you don't pass that minimum score threshold to become a member, then unfortunately aren't going to be eligible for any credit facilities at that point. I would say that that credit threshold is a pretty fair representation of what every financial institution is looking at when it comes to issuing credit.
Okay, well, pass that
So,
one.
for example,
Yeah,
go ahead.
No, sorry. Let's hear your example.
So my example would be, say, around the 650 to 680 mark. If you're below that, I think it would be very, very difficult for you to obtain credit, because that usually indicates that there's significant deterioration of the credit at some point in time within the last 7 years. And you can take a peek at your own credit bureau to kind of get an idea of what you'll need to do in order to build that up, to get over that threshold, in order to become a fit for, credit facilities from a personal perspective. And that's under certain amounts. The challenge is that when you're talking about over a certain amount of credit that's being extended to you and under a certain amount of credit that's being extended to you, it's almost like two different products completely. And then if you're talking about, let's go to the startup stage, well, most of the startups, especially the institutions that have auto adjudication, for example, so you go in, you sit down, you really don't need accounts receivable or anything along those lines. The system just automatically approves you a certain amount of a line of credit based on your personal net worth and based on your credit score.
And so you both made the point that it's a really good idea for entrepreneurs to pull their own credit report, so you know what your score is and that you see what's actually being reported against you. And I will third that. I think that's really important too, because I've certainly seen errors on credit reports. And so if you are applying for credit, or you're looking for a line of credit or a loan, you certainly want to make sure everything on that report is accurate. Mm-hmm. And you've both talked to that score, that 650 to 680, and just to kind of recap on that beacon score, normally the scores on credit reports really range. And if you have a score in the 800s, that's considered a stellar credit score. If you have a score in the 700s, it's still a very strong score, and you can be proud of that for sure. If your score gets down in the 600s, what I'm hearing is some people are struggling to find, to get a loan or get a line of credit if their beacon score, their credit score gets down in the 600s. And you're hearing kind of a minimum score of 650 or 680. I know that not all financial institutions, use a firm credit score in determining whether someone's eligible or not. And certainly we're hearing that today from Mike and Caillie, that it does go beyond the score. They are looking at your whole debt picture. But when you get in that score in the 600s, it could be challenging to actually secure a line of credit. Before we move on and talk about personal net worth, I just wanted Mike to be able to address that question that Caillie put forward, that members need a minimum credit score in order to join the credit union. So you already know their credit score.
So I wouldn't know their credit score until they come in. And I think each member that would come in, or non-member that would come in to open up an account with the credit union, will obviously assess and take a look at what their credit score is and risk and things like that. But I've not turned anyone away with this credit score of less than 650. I think when you're looking at a credit score that is in the more higher risk area, the 600 to 650 range, you just have to have a more meaningful and holistic conversation with them and maybe bring more people in to talk about the risk. So it could be someone that's had a bankruptcy 5 or 6 years ago, maybe got divorced, lost their house, and, and all of a sudden their credit bureau went from 700 to 600, and if they've handled everything professionally and properly, then there's no reason why we couldn't make an exception for something like that and have a meaningful conversation and maybe bring the person in as a member. But
yeah.
When the credit scores get that low, we just have to have a deeper conversation.
Right. Okay. Good. Thanks for clarifying that. I'm just looking at my clock here to make sure we're on time. It looks like we're right on time. So let's talk about that other topic that's come up a few times, and we've heard that PNW, personal net worth. Bankers, credit union people, Women's Enterprise Center, we use that term a lot, PNW, personal net worth. And you heard both our guests today say that it is something they consider. So let's get clear on what personal net worth is and what do you consider, what does that entail, and how do you consider it? And I think it's Mike's turn to start us off.
Yeah, so personal net worth is a component of measuring risk. It's a component of measuring a member's personal financial position, their successes, or their challenges and
struggles. Tell us, Mike, what is personal net worth? Yeah. I mean, what is considered a
sum of all of their personal assets, whether held solely or jointly, with family members or perhaps friends, family, less all of the debts.
So you're saying if I made a list of everything I own, that's my personal net worth?
Could be.
It could be? Okay, why wouldn't it be?
Well, we might not look at something like maybe you purchased some Bitcoin for $25,000 and you were trying to convince me to invest and you had it on your net worth statement. I might not assign an asset value to that of $25,000.
Mm-hmm. Okay, so it might be my personal net worth then might be if I own a home, the value of my home. It's going to be my vehicles, probably.
Your personal vehicles.
Maybe any RRSPs.
Some RSPs.
Any investments that I have.
Absolutely.
Or a boat, my motorcycle, my horse trailer, like all of that.
All
yeah.
of that.
Okay, good. But are you going to take anything off of that? What about that mortgage that I hold?
And that's debt. Yeah, so that comes off of the assets. So assets minus your liabilities. So mortgage is a liability. If you have a personal line of credit that you've used up, that might come off as a liability. If you have debts owed to other institutions, that's a liability.
What about my credit card debt? Is that going to be considered too?
Absolutely.
Right. Okay. So, so what you're saying, Mike, then is my personal net worth is going to be everything that I own minus all the debts that I have. Simply put.
Right.
Right. Okay. Caillie, do you want to add anything onto that?
No, I think that sums it up fairly well. Yeah.
When we're looking at applications for members, and you can almost rationalize like this: if you had a 46-year-old man in your office and you were doing a credit application and they had a net worth of zero, well, and maybe he's a professional architect or something, that doesn't make a lot of sense. There's something wrong, right? So you wouldn't expect a 20-year-old to come in with a net worth of $250,000, just getting established, maybe just finished university, maybe getting into a landscape company or something. So we try to rationalize where they should be in their life and kind of equate that to risk.
Okay. Do you do the same, Caillie? Do you look at the stage of their life and does that influence your decision?
Yes, that's correct.
Yeah, and so on that note,
I would caution you on that, because unfortunately some of the financial institutions that use auto adjudication programs, they don't necessarily take that into consideration, because it is a computerized system that's basically creating a response, and so it doesn't necessarily take into consideration your age or life stage. It just takes into consideration what your overall net worth is and your credit score.
I see. Okay, so if you're using a formula based in a computer,
a matrix,
okay, matrix and algorithm, computer algorithm, it may not provide for those anomalies, like someone being a student or somebody being younger. So would you then, as an adjudicator, can you override that computer decision, or are you strictly bound by what the computer comes back to you? Caillie, do you want to tackle that?
So I've worked at different financial institutions, and the financial institutions that I've experienced have the auto adjudication program. RBC does not have the auto adjudication program. So we essentially are offsetting the risk and mitigating the risk ourselves verbally with telling a story. So it all just depends on which financial institution you're working with and how they actually adjudicate credit. So it completely depends. Technically speaking, when it comes to a startup, if it doesn't fit the program and it's an auto adjudication system and they're looking at it from a startup perspective, there's no way to overcome that, because that's how the system determines whether or not somebody has the credit capability or is able to obtain it.
Okay, good. Thanks for clarifying that. One thing that I get asked kind of separately on this, so let me just throw it out there because it does come up, is student loans. People always ask me when they have a student loan, they somehow think that because they have a student loan that financial institutions are going to adjudicate them differently. We don't at Women's Enterprise. A student loan is equal to any other loan, but
what's a good loan?
Yeah. So do you look at student loans, the debt from a student loan, differently than any other kind of debt, Caillie?
It's funny that you say that, because it depends. So if you are a doctor, dentist, or a tier 1 professional, or you have a professional designation of some kind and you have a student loan, we are going to look at that differently. If you are everybody else who's just going to get a business degree like myself, then unfortunately you fall into the same category, and your student loan is definitely considered a liability.
Oh, okay, good. Thanks for calling. And same for you, Mike. You're nodding your head.
It's liability. It's a good liability. I mean, you're paying money to get your education, to get financing to do that. That makes sense.
Right. So having a student loan does not disqualify you from applying for a line of credit.
I just wanted to touch on that matrix piece, the auto adjudication versus not doing it that way, if that's okay.
Yeah, go for it. Yeah.
We do use a matrix system, especially when we're out mobile, we're meeting with members, and we will put in their information in the matrix. Our system will auto approve or will ask for more information, in which case then we can go to our credit managers and have a discussion with them about why we support and want to think that the facility be authorized or approved. So if the matrix system says no, it's not an automatic no, we need to look at this a little bit deeper and maybe look at different options, maybe different security, et cetera, et cetera.
Oh, so if the computer identifies it as a higher risk potential, you might still go ahead with the line of credit, but
Correct.
you might look for more security on the loan.
Yeah, exactly.
Okay, good to know. Just sort of.
Sorry, I would just challenge you a little bit on that, Mike. Not on purpose here, but I think that it would depend on the reason. Sometimes if there is no ability to mitigate, so for example, if somebody comes in, they have a 500 beacon score and they have zero net worth, very challenging to mitigate that particular situation.
I would refer them over to the women's enterprise.
Right?
Yes, well.
So really challenging. So it depends on what there is to mitigate, right? So if we're mitigating something to create a little bit more net worth because the system's read something wrong or there's something incorrect on the credit bureau and we're adjusting that, depending on what you can do to actually mitigate the issue, that's where, yes, everybody has the ability to kind of have that conversation. But in the end, it's still really challenging. You mentioned before about somebody who had been bankrupt, say 5 years ago. That would make it really tough in pretty much every institution that I've worked with for me to be able to lend any credit at all without cash security.
Yeah,
in
the case like that, we did use cash security. So you're right. Every situation requires a unique perspective, right?
And thank you for saying that, because I talk to lots of people who are applying for lines of credit, because we do loans at Women's Enterprise Center. We can't offer lines of credit, and some people go to their banks and credit union and are successful and they get a line of credit, and some people go to their banks and credit union and they're not successful and they're told that for whatever reason they're not eligible for a line of credit. And so it's good for people to hear that institutions are different. They look at mostly the same kind of things: their personal net worth, your credit situation, your business and what stage the business is at, but they may value them in different ways or put emphasis on different portions of that. And so it's good to understand what your bank or credit union looks at so that you can make sure you're the right match for their program and be successful in applying for the line of credit. Just before we move on and we're going to tackle some of the questions, I just want to clarify the one thing on the credit score and make sure everyone understands. When you get approved for a line of credit, that does show on your credit report. So Equifax does report that on your credit report. And I see that all the time on credit scores. Mike's nodding his head. Caillie, would you agree RBC does report that to Equifax?
I would disagree because we do not. So we do not report anything that's considered business credit to the credit bureau if it's under a corporate name.
Right. So
if it's under a proprietorship, that's different because you've basically personally guaranteed it. It's the exact same thing as applying for a loan essentially for yourself. The only difference is that you're using it for business related purposes.
Yeah.
Okay.
So we do not report business credit. So say one of my clients has a $700,000 or $900,000 line of credit, they're not reporting that personally.
No.
Right. So just to clarify then, you're saying that if there is a personal guarantee, it will be reported, and if there's not, it won't.
Just to clarify that further, if there's a personal guarantee, no, it will not be reported. It will only be reported and depending on the financial institution, not at RBC at all, if you're a sole proprietor.
Okay, got it. Great, thanks for that. Let's take a look at some of the questions. I'm showing we have about just over 10 minutes left. Carrie Lee is joining us with some of the questions.
So I have a question here that I'm a newcomer to Canada, about 1.5 years. So do our assets in our own country, can they be used in our personal net worth? We don't have liabilities here, but it definitely takes time to have our assets transferred. What are your recommendations?
So they've got assets in their home country, not in Canada, and they're wanting to know if they can use that as security on the loan. Caillie?
I would say, unfortunately, no. Not with pretty much any institution that I've been with. They would decline that as being a typical asset because we have no jurisdiction over the asset. So a true asset for us is something that is in Canada that we have access to. If they can bring a portion of that asset over and we can use it as cash security until they establish themselves from a credit bureau perspective and maybe a credit perspective, then essentially we would have something to go on. But generally speaking, unless the financial institution has a startup program specifically geared for new immigrants, you're going to have a challenging time trying to access credit because you don't actually have a credit score for us to take a look at.
Right. So there's the two issues there, Caillie. There's the issue of securing the assets which are in another country, which you can't do, and then there's the issue of the credit report. When you move to a new country, your credit generally gets zeroed. You can't access that person's credit history. And so Carrie's wondering how long it takes to build credit. That's an excellent question, Mike. How long does it take to build your credit?
Yeah, that's a great question. I don't know if I could actually put an answer to that one. Let's touch on that last point for a second there. I think there are ways to bring over credit reports from other countries through some FIs, like HSBC comes to mind. If you're a doctor in India and you are planning to move to Canada and you don't have a credit report here, I know that they will open up accounts for you in Canada and get your credit bureau opened up for you and get that rolling. So it's not an instant process. It takes time. I don't know how long it takes to, say, get an 800 beacon score. You don't just open up a credit card and all of a sudden you have an 800 beacon score. So it's a historical based number.
Yeah. Good. Okay. Thanks. Caillie, question.
Another one here is, and I'm not sure if we've clarified it enough, but just to touch on it quickly again, what is the difference between a personal line of credit and a business line of credit? Can we use a personal line of credit for our business?
Yes, thank you. That's another excellent question. Caillie, how does RBC separate those, or do you separate them?
Well, technically, that's up to the entrepreneur. So you can use a personal line of credit to fund your business activities as much as you would like to. Usually, it's a decision of the accountant because they're trying to separate your personal liability with business activity. So it's the accountant who generally suggests that a business line of credit is overall a better option for business owners, specifically because you have that separation. If you ever go through a CRA audit, if you don't have that clear separation of interest and you're trying to deduct things, it can just make things a little bit messy from an accounting perspective. But that's completely up to you. I mean, you're able to self-fund a business. We encourage equity injections, and if equity injections coming from a line of credit that's needed to secure your home and that's how you're accessing capital, then that's completely your decision.
Yeah. So what you're saying then is it's the entrepreneur's decision whether they use the personal line of credit in the business, but on the tax side, there could be some implications. So you want to talk to your accountant about that.
Correct.
All right, great.
It can be an expensive process separating those two. Absolutely. So I mean, the best advice is to tell the entrepreneur to have a good conversation with their accountant before they do something like that.
So do that first. Have that conversation with the accountant. Do that first. Make sure you're keeping accurate records so that if you are ever audited, you have a clear path.
And imagine, how much you're paying an accountant to dig through your receipts and separate business from personal. Yes. You're looking at many hundreds of dollars an hour. It's a lot of money.
Yeah. Good point. Questions? Caillie.
I have a question here again. Is the line of credit better than a loan? Will it have a lower interest rate? And she apologizes that she might have missed that I think we touched on it briefly at the beginning, but if we can just distinguish again quickly in the wrap up.
Yeah, let me just talk about that just a little bit, and then maybe we can hear from our guests. So interest rates vary from institution to institution, and they're usually based on a prime rate, which is generally set. Most institutions use the prime rate set by the federal government. So, to determine your interest rate, you really need to talk to your financial institution to see what they're offering because they are all different. And of course, a a term loan, an actual loan versus a line of credit is likely to have a different interest rate because it's a different process, and there's different risks associated. And we heard that earlier, that a secured line of credit and a secured loan, if you offer security, could have a lower interest rate. Whereas if you didn't offer security, or there were higher risk factors, and we've heard about some of those risk factors, it could have a higher interest rate. But of course, every institution is different, and you really need to check with the institution. Mm-hmm. And I think that's really all we can say on that now, because we can't throw out an interest rate because it does vary so much. Yeah. Another question, Caillie?
One that I thought of was, you were talking about inventory potentially being a guarantee for a loan. How is the value of that inventory determined? Is it, purchase invoice? Does account have to be done? What are you looking for as far as if you're securing a line of credit with inventory? What does that process look like?
Right. I don't do a lot of that myself at Prospera, but I have done in the past. And inventory can vary business to business, industry to industry. So again, I'll use the restaurant as an example. If you've had the food sitting on the shelf for 2 months, that inventory value is not worth very much at all. So for a restaurant, you're not going to see much of a value assigned to that inventory. But if something's very saleable and marketable, so plumbing parts or things like that, right? You might assign a lending value of 50% of the purchase price, something like that.
Okay. How about for you, Caillie, determining the value on inventory?
Well, I'll just give you kind of the rule of thumb. So the rule of thumb is that inventory is usually secured at 50%. Now, that's going to depend on the quality of the inventory, as Mike was saying. If it's considered perishable, it's going to have a lot lower value to us, so to speak. And if it's considered something that is harder to sell or liquidate, we're going to have a difficult time sort of kind of capitalizing on that, and maybe it might not get to that 50% mark. But generally speaking, inventory is looked at about 50% of its value. And then we also take a look at what would be considered obsolete, right? So if you have obsolete inventory in place, we would subtract that from the inventory, and then we would take in 50% of whatever the quality inventory is. So really, we have to assess what the inventory is in order to give you a kind of an idea of what that looks like.
Right. So you're looking at what the inventory is, and generally around 50% is your valuing at it.
Correct.
Okay, we have one more question.
The rule of thumb is 50%, yeah.
Okay, great, thanks. One more question. I get asked this question a lot, so I'd like to throw it back to you two. And it's a simple question, but a hard question at the same time. So the question is, what's easier to get, a line of credit or a loan? I get asked that all the time. So let's see what the folks that give lines of credit and loan. We only do loans, so it's something that I'm going to send you back to your financial institution to ask. So. And maybe there is no answer, but let's throw it back there, Mike. What's easier to get, a line of credit or a loan?
I don't know. I've not been asked that question before. They're in my world, they're generally adjudicated similarly. I'd say it depends on the industry, what it's needed for, the history that we already have with the member, if it's a startup or an existing member. So what's easier is, it might depend on the relationship. We had a member come in yesterday, and he wants to buy a new truck. We've dealt with him for 15 years. We know everything about the member. It makes sense, so we could authorize it right away. We didn't even have to do much of the paperwork. We're like, yeah, go shopping, you're good. So that's easy. Whereas a startup might come in and say, I need a line of credit for my plumbing company, and I'm just getting rolling. Well, we have to do some more due diligence. Right? We need to learn about the new member and their business plan and their forecasts and looking forward. How are we going to get repaid? So right. That's a very difficult one to answer.
Yeah. And Caillie, for you?
You know what, I'm going to say it's going to depend on which financial institution you go to ask for credit. So, and the reason why I say that is because some of the financial institutions, they actually have programs that are referred to as running start programs. So you come in for a startup and they auto approve you for a specific amount of credit. Generally speaking, they usually auto approve you for, they're called Visa line of credit. And so essentially what they are is they're a line of credit priced between prime +1 to prime +6. And it's a line of credit facility that's attached to a Visa card that you can access and transfer in between accounts. So from a startup perspective, that seems to be a very easy product to actually obtain. When you go to a financial institution that has a startup program, from an auto adjudication standpoint, those are very easy to access. I think that if you're, it's going to depend exactly what Mike said. What are you coming in for? What kind of business are you? So, you know, if you're a business that is basically service-based, that has a lot of accounts receivable, then it's going to be a lot easier for you to obtain a line of credit than it is for you to obtain a loan, because we can see that there's actually a working capital gap there. So it makes sense to provide you with a line of credit. You know, if you're going into a situation where you're going to go buy a building, well, we're going to do a loan. We're going to do a loan, not a line of credit, because that just makes more sense from a cash flow perspective, and it just makes more sense from a balance sheet perspective. So we would put that we take that into consideration and make the decision. So it really depends on what industry you are, exactly like Mike said, depends on what type of business you are, and it depends on, you know, whether or not you have accounts receivable as part of your business structure, or if, say, you're cash based.
Mm-hmm. And I think that financial institutions, Prospera, RBC, I think we're really investing in technology to help us be more nimble to get to that yes faster, or maybe not this way but that way. And I think that's important for entrepreneurs to know, is that we are all working very hard to help entrepreneurs be successful, and get them with the capital that they need.
So what I'm hearing then is it's the story. It's the member, or it's the client coming in, meeting with you, describing what stage of business they're at, what their needs are. You're taking a look at, you know, the history of that business, whether it's a startup or existing, and the financial situation of the business. You're looking at the person as well, what their history has been with you or with other lenders, their full credit history, what their personal net worth is, what the net worth is of the business. And you're determining if it makes sense, to move forward with a line of credit, or maybe a loan is better, or if they qualify at all. And it's really a combination of many factors, and we've touched on some of those here today, many factors that go into making that line of credit decision. We've also learned that institutions are different, and they do look at things differently. So it makes sense to go in and meet your account manager wherever you bank, or if you're with a credit union, have those conversations to see if there's a match there for you. I think we've addressed all the questions, and I see we're just about at 1 minute at our timeline here. So thank you. I would like to thank all of you for joining us here today on the session of Lines of Credit. As I mentioned before, it is recorded, and you can get a recording of it if you'd like. I'd really like to especially thank our guests here today, who I know have taken time out of their busy schedule adjudicating loan applications and lines of credit. Thank you, Caillie, so much in Maple Ridge from Royal Bank of Canada, RBC, for joining us. And Mike from Prospera here in Kelowna, thank you for joining us as well. And thanks again to Mike for suggesting this idea. It's a great idea. It's something I get asked a lot as a loan assessor here at Women's Enterprise Center. So it's nice to dig a little deeper on this topic. Thank you all again for joining us, and have a great day.
Thank you.
Thank you.